he's had an operation, so I'm chairing today. So I'll try and do my best for everybody. We have a new member on the committee, Sophie. So welcome. I'm sure you'll fit in well with this group. First item on the agenda is whether there are any urgent items or announcements. I don't believe there are. Are there any items to be considered in the absence of the public and press? Yeah. Yes?
Item 23.
Item 23. Which is a breach on last meeting. So this is going to
Hi, Steve Davenport.
Everybody hear me? Yes, that's fine. Thank you. Okay, so sorry for that. So we'll go on to the minutes. I'll take accuracy first. Has anybody got any issues with regard to accuracy? Yes, Ian.
Well, I wasn't in
From
attendance.
the fact you weren't there.
Yeah, I wasn't actually. I'm glad I've got such presence that it's felt when I'm not actually here. But I did manage to get the substitute along, so merit star for that, I think, Chair.
So can we make that correction, please? Is there anything else on accuracy before I move on to the actions? No. We have a list of those that are completed, so we'll just stick with those that are open, which I think came up mainly from the last meeting. The first action is in terms of reference, and that will be due to be commenced by April 2023. Are we still on course for that?
Yeah.
Yep. Similarly, the next item is about bringing the tram system back into public operation, and a regular update on this was requested by the committee. We do have a presentation today on the tram system, so that will cover that with Pam. Thank you. And then we've now got the Doncaster Sheffield Airport risk in the risk register, so that's actually complete. Although, I mean, I did go through that 2 days ago, and I'll feed back to you with transport risks. There's nothing in there about mitigation, which obviously can't be done, but there might be something on impacts and how we can pick that up that ought to go into the risk register. Committee requested more information on risk trends and how this could be flagged and with regard to financial risks as well. When we come on to risks, I mean, I will say at this point that I'm actually very impressed with the amount of work that's been done on the risk process and the risk register. It's moved up a notch. And I hope everyone else will get that view when they look at it. So I think we're certainly starting to take those actions on board. Head of Corporate Governance to create and circulate an insurance map to members. That's under development. Do we have a date for that? Can we put a date in the next meetings? Work plan, see agenda item 21. Okay, that's ongoing. It's on the agenda. And all the rest are complete. So let's move on to, we were asked to rearrange the agenda and move item 9, which is the external audit report ahead of the health and safety report, but we haven't actually got any attendees from our external auditors. So I will leave it as item 9, if I may, Mike. We'll come to it then. Let's do health and safety. I think it's good practice to have health and safety early on the committee agenda, because then it shows that we're paying good attention to this. So I'm pleased that it's up there at the top. Does anyone want to take us through the report?
Let Lynne from Health Safety Managers here to.
Okay.
Morning everybody. Obviously the report's already been circulated, quite a bit of detail on where incident numbers have increased or decreased. I just wondered if anybody had any questions or wanted me to elaborate on anything that's in the report.
Thank you, Chair. Yeah, just a couple of very quick ones from me. First one is, I couldn't see RIDDOR spelled out anyway. I kind of know what it is, but I'm not sure if a member of the public was reading the acronym RIDDOR, they'd really fully get it. Probably useful just to spell it out, please. And then just a couple of others. 344, you're talking about emergency evacuation plans and concerns over interchanges being able to evacuate safely in the event of an emergency. That's a slightly worrying one in that if we do have a terrorist attack or a fire or something and we can't get people out of the interchanges safely, that's clearly a big corporate risk for us. So I'd welcome a comment on that. And then just a very minor one, I was just looking through the annexes and I could see all the various interchanges there. And I went, question mark, don't we have an interchange in Doncaster, which I couldn't see in it anywhere. You've got sort of, I knew it was Bing and Ring, Barnsley and Rotherham interchange, but no Ding. So I was wondering what had happened to Doncaster.
I take on board what you're saying about RIDDOR. I'll make sure it's explained in future reports. In relation to the emergency evacuation plans, I've been doing quite a lot of work recently, and I'll be putting a paper through to Executive Leadership Board about some proposals. I've run quite a few mock evacuation evacuations at the interchange that I think has got the biggest risk for us, and things aren't as bad as I initially thought, which is a good thing. But there are some recommendations that I'm going to put to Executive Leadership Board which will need some resource, either human resource or technical resource, and that should be going next month. But things aren't as bad as I originally thought. In relation to Doncaster, we don't actually manage Doncaster. It's run as a PFI, so it's run by a private company. However, any major issues that may arise there are always brought to my attention, and touch wood, I've been here nearly 4 years and we've not had any major issues brought to my attention, so that's why Doncaster's not on the report.
I have a couple of questions, if I can, also observations. We've been trying for a long time actually to get data back from Sizewell on health and safety incidents with regard to the tram, so it's good that we've now got that engagement. You put in the report that there were 16 actions that have been identified with regard to that audit with them. Were any of those of any concern to this committee? Shall I read it? It says, in total, 16 actions have been identified during this audit, and progress against these actions will be monitored monthly by the HSQE officer for light rail.
Yeah, that's not myself, that's somebody that we employ.
The
Yeah.
question is still relevant.
Yeah, there are no major issues that would need this committee to be involved in. There just tend to be a lot of how things are reported, standard things that he's on board with. They've got an action plan and he monitors that. But I asked him if he wanted me to bring anything else to this committee, and he said there was nothing that needed raising at this point in time.
Okay, and now we've got this engagement with Sizewell. Are they being sort of cooperative and helpful in this regard? I think we assumed at one point that they weren't being helpful, but has that relationship now moved on?
Yes, it has. The Health and Safety Light Rail officer meets with the Health and Safety officer from Sizewell on a regular basis. He's fairly new in post, and he's been able to nurture him, if you like, mentor him a bit, get him to our way of thinking, and they've got a really good relationship. The reports are in the format that we want them in. They've got more detail in than they used to have. So I'm quite happy that moving forward things will continue as they are.
Okay, thank you. Anybody, any other questions before we move on? Right, as I said, with regard to the external audit, we don't have any representation from the external auditors. We are well behind in getting these accounts signed off, as we know. It doesn't seem to be getting any better. I think there is a little bit of light at the end of the tunnel, and hopefully when we sit here at this next meeting in March, everything will be done, but Mike will give us an update as to where we are.
Thank you, Chair. So yeah, the partner from EY sent his apologies. Unfortunately, he's on bereavement leave at the moment, and his substitute, the audit manager, Sue, is also sick at the moment. She did, however, give us a very brief update at pre-meet about half an hour ago, so I can update the committee on progress as far as the accounts and the audit is concerned. So the EY have provided an audit findings report to tell you as the committee how far they've got in the audit of the PTE's accounts up to this stage. There are a number of outstanding queries that were listed in the report. We've had an update and a discussion this morning, and hopefully the chair has been reassured that the list is shorter than was portrayed in that report. What we have agreed to do, though, to ensure that we can get this audit wrapped up as quickly as possible, is to meet as soon as the audit manager is fit and healthy again, and we will rattle through those outstanding queries so we can draw a line under the PTE's account. You'll note in there that they're not actually raising any matters of significant concern. They've done their work to conclude, at least in principle, that the value for money position is unqualified, or there is nothing with the exception to report. So hopefully committee members can be reassured of that. I've also checked with Sue, the audit manager, about when the committee can expect to see the audit findings report for the MCA single entity and the group accounts, and we've been reassured that subject to getting the last remaining outstanding queries dealt with, which I've given my assurance to Reece that I will ensure my team prioritises these, that report will come to this next committee in March. So I'll pause there, and if there are any questions which I can answer for the committee, I'll be glad to do so.
David.
Thanks for that report, Mike. I've got a couple of comments and probably just one question. The comment was, if I'm reading the report correctly, it looks like we're going to get a clear VFM conclusion, and the only error appears to be one that emanating from South Yorkshire Pension Authority on pensions, which to me looks like a really good result today. I don't want to prejudge anything all coming out at the end, but you know, MTA's, PT's accounts are not straightforward, so to get no errors found by the auditors sounds very good to me. Yeah, you've sort of covered my next comment which was going to be just checking on the remaining work and what was left to do. It doesn't sound like there's too much. There is one point on a thing on year-end journals, blanket authorisation. I just wanted to just understand a little bit more about that. I mean, are we talking you've got 10 year-end journals and you could authorise them individually, or are we talking you've got 10,000 and it's totally impracticable to take that auditor's comment on board? But that's the one thing they're asking you to look at. So I just wanted some officers' views on the implementation of that.
I'll be glad to give you a very frank view on the latter, but let me just see if I can cover off the other points. So VFM, yes. As far as they can say, as far as I've been reassured by Sue, the audit manager, VFM is tick done and clean. More importantly, the uncorrected adjustment on pensions is, again, that is after subsequent valuations and review. You know, that's not an error in our accounts. That's simply a valuation statement done by the actuary that's re-changed the position. And like you say, 1% and a bit change is next to nothing. So no concerns as far as I see. As far as year-end journals concerned, you know, there's a high volume of journals at year-end. That's inevitable. And I personally do not believe that it is necessary to sign off every individual journal. I think that is overkill. Why do I think that? Two reasons. One, there are mitigating controls which I think are strong. So this process of signing off en masse, it is common practice. It's not just something we've introduced this year. We've had unqualified accounts for the last 5 years that I've been here, and this hasn't presented us with any concerns around the risk of fraud or error in the accounts. And the lady to my left will hopefully reassure you that her team audits core financial controls, including journals, every year. And again, we satisfy ourselves that there is, you know, the auditors have satisfied themselves that they give us a significant assurance of our core financial controls, and journals is part of the coverage. So from my point of view, Dave, I would disagree that it's a serious deficiency in our controls because we have mitigating controls in place to address that.
Just one thing from me, Mike. It's related to the delays and the amount of work that you're having to put in. From the pre-meeting, we've understood that this is actually having some impact, certainly with areas with internal audit, for example, because you've got to provide resource for that. So the sooner you get this sorted, the better. But in terms of, you know, risks for things going forward, how much does this impact the fact that your team is struggling to get this through?
It has quite a heavy impact, to be honest. I mean, any team manager will tell you that in quarter four, we get to the point of the year where people are trying to use up their annual leave allocation on their flexi balance for the overtime that they've worked, and Q4 is the last opportunity to take that time off. And it's good for people's mental health and well-being that they can have enough time to recover, particularly for accountants who are ramping up for another year end coming up very shortly. So I want to make sure that my team are fit and healthy and ready to go for 22-23 year end. My concern is, though, that they have a number of other conflicting priorities that they have to deal with. And as true professionals, they and I would want to make sure that we tackle all of those. So if I was just to give you a handful, we want to make sure that core financial controls for 23-24, the audit is done and dusted, so Lisa can report back to this committee in March that they're satisfied with those controls. We have the important matter of getting the 23-24 budget set for the group. That needs to go to the MCA board in March, along with the Treasury management strategy, which we've got on this agenda. That needs to go. And obviously there's the matter of the dissolution of the PTE and the practical steps required to ensure that all the matters that relate to finance, as well as other teams like HR and legal, have been done on a timely basis, ready for the 1st of April. So my concern, Reece, is that all of these are coming together as a perfect storm, and what I want to make sure is that between them we can minimise the risk and give Gareth and yourself the reassurance that, we've mitigated as much as we can the risk of any of these things going wrong.
It might be worth you at March's meeting just giving us a word or two on the pressure you're under and how it's moving, because we need to know whether it's getting worse or getting better, I guess, at that point.
Chair. If I could just add a little bit of context, the real challenge in all this is our ability to plan our resource. So we know we have a generational integration project, huge change management project that we've never done before, where we would dissolve City and transfer all the assets, liabilities, functions and competencies from one statutory entity into another. We knew that was coming. We knew we'd had to set a budget for the new financial year. We know we're working on a Tran concession end project, which again is a generational challenge. So we have to plan our resource accordingly. So when an audit takes 7 months to complete and occupies teams, not just in finance, but across the breadth of the group, in delivering something that we should have put to bed in the autumn, the consequences of that are that we're asking the same teams to deliver more in a shorter window. And eventually it starts to tell, and we have to slip and we have to compromise on quality, and that becomes an issue for me in delivering assurance for the rest of the organisation that the finance team and other teams within my purview are able to adequately support. So there are real world consequences to this very important activity taking much longer than it should do, and that becomes an ongoing challenge for us, and we simply can't have this year after year after year where things get progressively worse without intervention within the audit market from government.
Is there anything the committee can do to help in this respect? I mean, is there pressure that we can put in any particular area to help that you think might be beneficial?
I'm not sure, other than maintaining vigilance within the committee and impressing upon our external audit partners the importance of pragmatism and how they approach this, and equally the importance of really close communication and collaboration, particularly with people in Mike's team, such that we are better able to plan our resource requirements than we are currently, where it still feels like lots of things are left field and we get unexpected issues that arise and soak up resource. So we understand that there are national pressures within the audit market. We understand there are inevitable labour resource pressures that manifest themselves in all sorts of places, including the MCA. But that all engenders much closer cooperation and planning than we're probably currently seeing. And I think that's where we can improve the system within the things that are within our gift to manage.
Okay, I think that was worth a discussion. Thank you for that, Gareth.
Yeah.
Sorry.
I mean, Gareth said it all, but I was elected, better say, it's a completely unsatisfactory situation that's been ongoing. I'm just looking here why I say they're building a better working world. Well, we're not building a better working world for us. And it's really for them to manage the process through. That's what we're paying them for, isn't it? So there's got to be a plan. If they're dropping questions in that are just soaking up resource, it's just not acceptable. Totally not acceptable.
No, I mean that's well said, and I think there is one area perhaps that can be heightened, which seemed as very much a shortcoming in the pre-meeting, and that is communication. And there's got to be a strong bridge of communication between both areas, and it's not helped by the environment that we work in now, where things are done remotely, it's done on screens and Teams, it's done by emails. You know, when things used to be done with meetings face to face, things got done more quickly, and maybe we have to get back to that way of working to try and speed things up. If there's one lesson that's been learnt, I think perhaps it's that, Gareth. There needs to be that followed through. But anyway, we sympathise with you, and we recognise that this has not been a good story. Let's move on, because we've still got very much a lot in the financial arena, which is where your workload is, as you rightly said. We have some very detailed Treasury documents coming up. I'm sure they vitalise everybody at night when they're in bed reading this, Mike, but well, take us through it. Really, I think we just need the highlights. The committee is here to be assured that you've got the processes in place to manage this, rather than, I guess, understand the detail. So over to you for item 10.
Yeah, it's my turn to say that I sympathise with members of the committee because Treasury management isn't exactly the most riveting topic. However, it is actually making a big difference to the health, the financial health of the MCA currently and to people of South Yorkshire. I'll come on to that point in a second. So the two Treasury management reports you've got, items 10 and 11, I was proposing in the interest of time, Reece, to talk to them in the round. From my point of view, item 10, which is the mid-year Treasury Management Strategy report, that is just for the committee to note. This has already been to the MCA board for approval, so to speak. It is one of 3 reports that we have to produce for the Audit Committee and for the MCA board every year. The first one in the year is the Treasury Management Strategy. So the one for 23-24, i.e. next year, is item 11 on the agenda. This time last year we brought that paper to you, and then we have to at the mid-year point say this is how we're doing currently against it. So item 10 is exactly that, 22-23 position as at the mid-year point. Then we have to produce one at the end of the financial year, so we'll be taking the closeout report to the MCA board in June. For the mid-year point of view, all that's really saying to you is that we're in a very good position, that we're meeting all our indicators, that we are on track with our borrowing strategy, which is predominantly no new loans, retiring existing debt and making savings on the revenue budget because of that. What we're also doing very well in terms of our investment strategy is we have been able to generate additional income in 22-23, and that has been good on 3 counts. Firstly, it has helped us to mitigate loss of core income that we weren't expecting when we set the budget at the start of the year. So one example would be a core LEP grant. We budgeted for £500,000, then the government told us belatedly after we'd set our budget that they were cutting 25% off it. So we obviously had to fill that gap. Second reason why this is good news is because, like committee members around this table who were used to hearing the story about pay and price pressures on Barnsley, Doncaster, Rotherham and Sheffield's budgets, same story here at the MCA. We're also having to deal with pay inflation and price inflation too, so this money helps to offset that. And thirdly, what we've been able to do with additional investment income is invest £4 million into a package of cost of living measures. So one very clear example of that, which will be relevant to people around this table who are interested in transport and public transport in the region, is the £2 fare cap, the Mayor's Fare. That has been funded from this additional income. So it is making a difference to communities of South Yorkshire. There aren't any particular concerns from my point of view as far as the mid-year report is concerned. If I then turn quickly on to the 23-24 draft Treasury Management Strategy, I do apologise to the committee. This is a mammoth read. It has to be detailed because it's prescribed under regulations and statute that we have to cover certain things. So one of the big appendices is the Treasury Management Practices. There are now 13 practices. We have to document all 13. And we have to be very specific in those TMPs. We've consulted with Link Group, which is our external Treasury Management advisor, on the prescribed formats, and ensured that any recent code changes, and I'll come on to that in a second, have been incorporated. And I've also, and my team have consulted with Sheffield City Council Treasury team, who run our investment strategy on our behalf. We've consulted with them fully as well. The main things to note are that for the Treasury Management Strategy, we're not doing anything radically different this year in terms of investment or borrowing or our minimum revenue provision. Those are broadly the same, so nothing for the committee to be concerned about in terms of a departure from that. However, there are a couple of things that have changed. So the Prudential Code has been revised, the Treasury Management Code has been revised, and those changes come into effect in 23-24. So we've worked very closely with our advisors to ensure that we are compliant with those changes wherever we possibly can be. We've also consulted with some of our South Yorkshire finance colleagues who work in Treasury Management. So Gareth and I have spoken to our opposite numbers at Rotherham, for example, and we've checked to see that the approach that they're taking with regard to code implementation, we're taking a similar approach as well. And we've been speaking to MCA Treasury counterparts, again, to make sure that we're consistent with those. Now, in terms of the changes that will matter to you most, as far as the new code is concerned, there is a lot more emphasis on ESG, which is environmental, social and governance indicators. One thing that we are doing is making sure that if we do change any of our investments, we look at the ESG rating to ensure that we're satisfied with that. I can also note that in terms of counterparties, we have an appendix in the Treasury Management Strategy that sets out the countries with which we will invest. One significant change to note for the committee is that Qatar has been removed from that list. I'll also note that there are new requirements around liability benchmarking, which we have done extensive work with Lynn on that, so we're satisfied that we can meet the code in that respect. One area where I think the committee will probably be most interested and where we will need to do some further work with your respective officers at the audit committees where you might sit in Barnsley, Doncaster, Rotherham and Sheffield is to ensure that between us we provide the right amount of training for you in order for you to be able to discharge your functions and scrutinise Treasury management. The code is going a lot heavier than it has previously in making sure that there's a full training and skills register for elected members as well as Treasury management officers. So there'll be further updates on that, Reece, for you and the rest of the committee to make sure that you get the training that you need. I just want to make sure that we're not duplicating effort between, say, Sheffield and ourselves or Barnsley and ourselves and providing the same training twice. That would make no sense at all. I was going to pause at that point, Reece, because I think I'll take the rest of the report as read. If Gareth wishes to add any other points, I'll leave it to him, but otherwise happy to take any questions or comments for the committee.
Questions? David, I'm sure you'll have some.
Yeah, thank you, Mike. You're right. The Treasury Management reports are unfortunately necessarily a fairly challenging read for a lay person. So I've got a sort of comment which I think you said at the start was, is the plain English version of the 23-24 that we've got a lot of cash, we're repaying 50 million of it next year, might borrow a bit for capital schemes, we're not going to take out the full borrowing out on the gain share, we're cautious with what we do with our cash, and we're going to stay within all our statutory limits. So I tried to summarise 50 pages in one paragraph there just for everyone's benefit. Is that a fair summary?
Beautifully done, Dave. Yes, I wish I'd put you on first before me. That would have saved the committee a lot of time. You have prompted me to make one point. Yeah, in both the item 10 and item 11, I've alluded to the debt cap, and I forgot to mention that in my preamble. So we have to agree with HM Treasury a borrowing limit. That's prescribed under the borrowing powers that we got at the start of the last financial year. So we can borrow in the same way as a local authority for both transport and non-transport activities. So those powers are still in place. We are in the negotiations with Treasury. We are reassured that what we've asked for, which would meet the requirements of our strategy, will be approved. We're just waiting for HM Treasury to come back to us to confirm that in writing. So that was the extra point, Dave. Thanks for reminding me.
I think Gareth has a point.
It was largely just to build on Dave's very helpful summary. I think, like every other local authority, we are governed by the hierarchy of considerations in terms of how we manage our money, and that is centred on ensuring security of investment. So the world remains fairly risky. We are acutely concerned about where we place our money on a day-to-day basis, and we continue to only place it within the strongest counterparties who are creditworthy. We are also concerned about liquidity. So one of the reasons that we hold large cash balances at the moment is because we have capital programme slippage. Now, we are doing an awful lot of work within the authority and with our external partners about how we address that, and we're hopeful that that capital programme slippage starts to unwind. Once it starts to unwind, our cash balances will come down. And we're also paying significant amounts of debt back at the moment. So next financial year, we'll be repaying over £50 million worth of borrowing. So the huge cash balances that we have at the moment, they give us some comfort and that allow me to sleep at night that the money will be there in the morning, will start to unwind in future years. So we have to be more cognizant of the fact that we'll hopefully be operating with lower cash balances, because that means we've got better delivery, a better capital programme. The other factor that's also working with us at the moment is around yield. So yield is the third of the considerations in terms of how we place our money. So we want safe counterparties, so they'll pay our money back to us. We want access to that money at the right time so that we don't end up in a borrowing position. But of course, we are also interested in yield. And yield's the money that is returned to us from the cash on deposit. And yield does matter because, like any other asset that we have, whether it be a building or an office block, we need to sweat it and we need to get the maximum value for the public purse. So over the past year, our Treasury management performance on our investment income has smashed all expectations. And that's happened for two reasons, as Mike says. One is that we have had high cash balances because we have had capital programme slippage. But the second is that the interest rates have just accelerated beyond where we thought they would be. Now, into the future, we are anticipating that they will still remain elevated over where they've been over the last decade or so, but they won't be quite as acute as they are. So inflation is beginning to taper in terms of its rise, and it might start to drop down. Hopefully it will. But that should mean that interest rates also move. But there's real opportunity in this now for us to use the cash in a way that we've not done over the last decade or so, where investment yields were so marginal that it just didn't matter how much money you had, you'd be generating an absolute pittance. Now, the interest rates are at something more akin to normal, and we do have high cash balances, our active management of that cash becomes really important to us. So you'll have seen within the pack, hopefully, that during the year we brought back banking arrangements. So they used to be delivered on our behalf by Sheffield City Council, who did a really good job. But we recognise now that as we mature as an organisation and as we go through integration, it probably makes more sense for us to do that. And we'll need to be much more involved and much more active in how we manage our cash balances, because there is a real prize to this now in the way that there wasn't when interest rates were at fractions of a percent. And it puts much more focus on us determining what our cash flow profiles look like and where we're willing to place our money within the bounds of this hierarchy of considerations. So we are shifting our policy and our strategy over the next financial year. We'll still be conservative in many ways. We'll still make sure that we're only investing with safe counterparties. But we're in a different place than we were a year ago, where interest rates were 0.5%, 0.25%. So it is quite a fundamental move going forward.
I have, sorry.
Somewhere I've been trying to find the page. There's a forecast on interest rates which show them coming down again to about 2.5% now. I've been around long enough to think that 2.5% is not a typical interest rate compared to, and I know we've had like 14 and 15% mortgages, I can remember that, but in terms of managing the cash, I'm not managing it, and I think, well, 2.5% is not normal. We'd be better at. I'd expect interest rates actually to stay elevated if we've got a good economy. Strikes me, inflation at 2%, interest rates at 3-4%, mortgages around that sort of level is a pretty healthy situation. So I just wonder whether officers are sort of like thinking, well, you know, that's guidance, but it's not necessarily what will be the outturn. So, what you're thinking on that? And the other thing is inflation. So it's good to have a decent return, and it's good that it's paid for those things. But we're going to be behind the curve for quite a while, aren't we? Really, in terms of inflation eroding what our cash our cash will buy.
I can pick up a couple of points. So, if you asked 10 different economists and interest rate forecasters what the answer is in the future, guess what? You could probably get 10 different answers. And my natural tendency is toward prudency, to take the lowest one, because what I certainly don't want to do is put the MCA in a position where it's banking on high interest rates and therefore high investment income, which doesn't then come to fruition. So we do exercise a degree of caution. We take on board the advice we're given, but then we apply our own professional judgment. The other point to note, because it is a good point from Councillor Auckland, is yes, on the face of it, right now there are good deals to be had, but the market is already pricing in the fact that they expect the yield curve to drop down. So therefore, people are now starting to think, actually, I don't think I should have to pay 4%. I think it should be more like 3%, because they're assuming that, again, the rates will drop. The other point we've got is we have an investment portfolio that does include long-term investments that were agreed like several years ago in the interest environment that Gareth described. So we're not getting the same yield that we could right now if we did an immediate deal. So there is a balance in the portfolio, and those old investments are dragging down the overall limit. So that's why you don't actually see a direct correlation with 4.5% that you might be able to get on an immediate deal. I know it's not a perfect answer, but that's some of the things we have to take into account at the moment.
Just a couple from me, Mike. One is a point of observation, because it actually knocks back into risk. It's a bit of a curate's egg. You've had a gain because we are delayed in our project delivery. So you've obviously been using that cash that we should be spending in that sense to get some Treasury benefit. But that's not what we want to be doing. We want to be actually delivering the projects on time. And in fact, if we don't deliver projects on time, it gives us a reputational issue. It doesn't also help you gain funding in the future if we're seen not to be able to spend it. So that's one thing that we need to know. I had got a couple of points that came out of the report itself. You talked about the borrowing potential, I think, arising another 500 million, I think I saw in the report. So does that go on top of this 660 odd thousand in this operational boundary? So we're now looking at a much larger number. Have I got that confused?
I'll take this one, Chair. So when we discussed the Treasury management strategy last financial year, the really significant change that we discussed was that the MCA had received the devolution settlement, so it had access to lots of long-term funding, but it also received complementary borrowing powers that will allow it to borrow for its non-transport activity. So this gave us loads of pause for thought last financial year about what our intentions might be around borrowing. And one of the things that we did discuss at that time as an organisation and with regional partners was about a significant investment programme that would be funded by borrowing. And that made sense for a number of reasons, not least that the devolution settlement gives us £30 million for 30 years. And in a really high inflationary environment, that long tail of cash flow that we can expect starts to depreciate really quite considerably. So rather than having £900 million in real terms, you might have £500 million or £400 million. So using borrowing as a means of accelerating that very long tail into the near term would offset the inflation, albeit with an interest cost, but also bring forward the benefit that would otherwise accrue in 30 years' time. So there were loads of reasons why it would make sense to think about this. So we did some calculations, we got an investment model, and we used that to determine what we thought the maximum we would be able to afford to borrow would be within this devolution settlement. And that came out to roughly £500 million. So for exemplification purposes and for the purposes of this strategy, we built into our operational boundaries an additional £500 million. And that was essentially saying that we've got headroom if we need it to borrow up to that value and we can prove that it's affordable through this modelling that we've done. So if we were minded to, we could go away and borrow and invest that money into the region really quite quickly. Now, we've done further work over the course of the financial year about the renewal fund, which is the term for our strategy, and we've done lots of work in particular about how we make sure that there's equitability in terms of the access to funding for each of the partner authorities within the region. And one of the conclusions of that work is that we've distributed notionally funding pots to each of the LA partners to give themselves comfort on what's available to them. And within that, there is a notional funding allocation for the MCA. So rather than talking about the full £900 million, we're now talking about a much smaller number. So again, we've gone through the similar exercise about determining what we think might be affordable to borrow against that MCA allocation, and that's within this year's strategy. So if you were to look across each of the four authorities, and the local authorities' treasury management strategies, and then ours, and you added it all together, you probably get back to £500 million in terms of what will be affordable, but we've disaggregated it now based on the work that we've done this current financial year.
Okay, I understand. Question, I think.
Thank you, Chair. Just a couple of little bits of detail. In the 22-23 report, you analyse the group's debt portfolio, and you make a comment that the 20 million of market loans include an option for the lender to change the interest rate periodically on specific call dates. Is that because they're lender option, borrow option, LOBO loans? Okay, and you know, subsidiary comment from me, if we can at some point get the opportunity to pay these flipping things off, it would save a lot of pain. And just, Gareth's going to come back on that, but just on the 23-24, there's then a comment that historically gross debt has exceeded the capital financing requirement. And I raised my eyebrows and tried to remember whether that should be the case or not. Thought it more normally possibly shouldn't, but I could be wrong. But you do then say, explain why, and it's because you've been notionally reducing your capital financing requirement by recognising minimum revenue provision, which is a statutory charge you have to make each year, but have actually not been paying the associated debt off, and that position will reverse in 23-24 when you make a big debt repayment. So I'm thinking it's not something I need to worry about, but I wouldn't mind just being reassured on that.
Yeah, I'll take those. Good questions. So for the benefit of the committee, Dave referred to LOBOs, lender option, buyer options, and the simplest way to describe these are that they are one-way bets against the authority in the favour of the banks. So many years ago, around the early noughties, there was these types of borrowing instruments were very popular. They were popular because they gave you a teaser rate at the start of a borrowing contract. So just give you a simple example, a bank might come to you and say, we understand you're looking for a loan for 20 years at £20 million, and we can do that for you, and we'll give it you at 5% for the first 5 years, and then we'll see where interest rates are. But if interest rates go up, we'll obviously increase the rate. Now, you might look at that and say, well, 5% is a lot cheaper than I could borrow off the Public Works Loans Board or other bodies, so I'll take it. But what that did was lock in very short-term gain, but leave you with very long-term risk. And they are starting to unravel in certain places, and lots of authorities are carrying lots of risk on their books. Now, the MCA and City have a number of these loans, £20 million worth, that I really don't like. I would really like to repay them. But of course, the banks will only allow you to repay if it's in their interest to do so. So we continue to monitor these, and if we can get out from under them, we will do, because I'd rather have a fixed level of risk that we know what we're dealing with, rather than something that's open-ended and that the banks will use to their advantage. The second point was about whether we are under-borrowed or over-borrowed. So just to simply summarise this for you, every authority, and this will be the case within your individual local authorities, have what they call a capital finance requirement, sometimes call it the CFR. And this is about the underlying need for borrowing. So if you looked at a local authority balance sheet, if you add up certain things, you can discern the level of debt. that that authority is carrying. And that should mean that all other things being equal, you have loans that equal that level of debt. So you might have £100 million worth of need for debts because you've financed assets or something else. So you'd have £100 million worth of loans. But as we know from the previous conversation about capital programme slippage, sometimes you just have cash sat around. So you might only have £50 million worth of loans and you're using £50 million worth of spare cash to finance that debt. And in that position, you will be under borrowed. So that your balance sheet would be saying you've got an underlying need for debt of £100 million, but you've got £50 million worth of loans on your books, so you're £50 million under borrowed. That is the traditional position. So that's where most local authorities are. So most people are under borrowed at the moment. And there's some risk in that because eventually you need the cash and you might have to go and borrow at a time when it's not to your advantage. SIPTI found itself in the reverse of that position for a number of years. So back to the 90s and the early 90s, SIPTI undertook a lot of activity, a lot of capital investment that would have been funded by debt. Lots of it was related to the tram system. So it built up a need for debt. But it also took out a lot of loans about that same time, and it took out, in time, more loans than the need for debt. Now that need for debt will change over time because government make us, under law, put money away each year, and we call that the minimum revenue provision. So each year we charge a bit of money to our books through to the transport levy, and that builds up cash. And the idea is that if you put a bit of money aside each year, when your loans fall due, you can pay them back. But the calculations that were undertaken in the past meant that the link between the money we were putting aside and building up and the loans that were generated were out of kilter. So we've ended up in a position where we've got too many loans for the underlying need for debt. So we're carrying more loans than we need to at this point, and there is a cost to that. So that is an awkward position for us to get into. So rather than exacerbate that, we've not taken on any borrowing for around a decade, and we're repaying those loans. So the trade-off will change in next year, where we'll go from an under-borrowed position where we've got too many loans to an under-borrowed position where theoretically we've not got enough. So this is really an important point for us to manage in terms of unwinding past decisions that we've had to live with for a number of years. But the consequences of this are that we're reducing the loan book. That means we're reducing interest rates, and that's one of the reasons that we've been able to keep the transport levy low for a number of years. That's part of our financial strategy.
Thank you for that, Gareth. That was a full explanation, but I'm going to move us on now because time's pressing. We've got a long agenda, so I think that covers everything, Mike. Thank you. Let's go to the assurance framework. Who's talking on this one?
That would be me. Thank you, Chair. Good morning, everyone. For the benefit of new members of the committee, just to make you aware that the assurance framework is a single document that sets out our governance structures and board committee structures that are in place in order to make financial decisions, and also it sets out the processes that we have in place for appraising and approving funding applications for MCA investment. We are required by government to do an annual review of that assurance framework, and that normally involves us speaking to local authority officers, our own officers, as well as applying any recommendations that have been identified through audit, for example, to make sure that we are continually improving our governance and assurance processes. We have appended the current assurance framework to the paper for you to have a look at, but just to make you aware that the review process for this year has been more extensive than in previous years, not least because Treasury have updated the Green Book guidance that our assurance processes have to adhere to. So we're currently working our way through that. This year's assurance framework for 2023 will also reflect the dissolution of the PTE as well as the evolution of the Local Enterprise Partnership Board, which is currently one of our key governance structures, as that evolves into a new type of business advisory board following the government's review of local enterprise partnerships. So there are a number of changes that we need to make to the assurance process this year. There are some improvements that we have made to the assurance process along the way as we've been going on through that review since October. We have formed a new programme management office team within the MCA, and that is a team of experienced project managers and thematic area experts who are now working alongside local authority partners and other partners to develop projects, and this was aimed at improving the quality of those funding applications that were coming forward. So that's been key in terms of actually helping to refine some of the business case development as well as to manage expectations. The other improvement that we've made so far is that we've also set up a new programme board, again within the MCA. That is chaired by Gareth as the Group Finance Director, and it consists largely of senior MCA officers. Their role is to maintain an overview of programme performance, and obviously there are a whole list of programmes that the MCA is responsible for administering, and they're also there to provide project officer level support and authorisation for project development, as well as to challenge some assumptions and make sure that the interventions that are coming forward for business case development are what the MCA needs to be funding. So it's introduced an additional level of robustness into the assurance process. The remainder of the assurance review for this year, we're continuing to meet with local authorities. Chief executives had a discussion on the improvements they'd like to see made to the assurance process, and we're having ongoing conversations with local authority officers as well. And the idea is that as we're gathering all of this feedback and also including the new requirements on us for what is known as the gateway review of the gain share funding, that's all reflected in this year's assurance framework. But the purpose of coming here today was just to obtain the committee's views on any other improvements that you feel that we ought to be making to the assurance process for 2023.
Do I have any questions? I've got one point, which is your item, which is actually when you're talking about the Audit and Risk Committee in the report, item 393. It talks about the independent members leading a non-executive audit and risk advisory panel which reports to, that's now finished, so presumably you need to take that out. There is the transport working group, which is a subcommittee effectively within this committee, which now exists, if you want to make reference to that.
Yep, thank you, Chair. We'll certainly make those changes.
Internal activities for us. Thank you.
Thank you, Chair. I'll keep it brief. I'll just stick to the key issues on page 3 of our report of the progress reports. You can see that we have completed 2 and published 2 final reports since the last committee meeting. I will take those separately after this item, but just to give you assurance that we've completed 151 days of the plan, which is equivalent to about 72%. We still have a number of days, obviously, to deliver before the end of March, but we are working collaboratively with the team, with Mike, with Gareth, in terms of making sure we've got access to the right people to be able to complete our work. I've got a team of 3 staff working on the remaining reports that we have to deliver. The aim is to provide our draft Head of Internal Audit report to the next Audit Committee in March. So the plan is to at least have all of our fieldwork complete by that date, even if we haven't got the final reports quite over the line. But there will be a handover process with the new providers. Normally, the usual process is that you will have your outgoing and incoming internal auditors probably at the meeting in June, where we will present our final Head of Internal Audit opinion. So we are still on track. If I could just move you to page 4 of the report, this just gives you an indication of what reports are left to deliver and what work has been delivered. it's too soon currently to give you an indication of what that head of internal audit opinion may look like, because you can see there we've still got a number of reviews to complete, but by March committee we will have that draft report to bring to you for information. So that's just an overview in terms of delivery. I'll stop there for any questions, if there are any questions. Thank you, Chair.
Yes, you've still got 60 days worth of work to go, which is quite heavy to do in the next couple of months. And I guess this is a reflection of the pressures that we've been talking about in terms of the team. But as far as you're concerned, you still believe you're going to be able to complete for us? Okay. We'll go on to your other reports then that you're going to present to us. I mean, the first one is with regard to closing out the recommendations on other reports. I noticed that of those that are overdue, the timescales are moving on again. We've had a third request to move those. And Gareth, is this again a reflection of what we've been talking about in terms of resource and close things out?
So the majority of changes that we're asking for here are supplier resilience report. There's two things happening here. One is labour market pressures. So you'll have seen this as a national issue. It's weighing on our ability to recruit and get people into teams. I guess second point is we, as part of the organisational review that is underway at the moment, we've had a slight rethink about how we discharge some of these functions, which has also led to a bit of a pause in activity whilst we work those through. So the team that will be responsible for delivering these actions is now recruited and is in place. We just need to get them working, so we're asking for just a little bit of time to finish off that work.
I mean, it is a big extension because we moved the date's about a year, I think. So hopefully that should give you plenty of time. Is there any risk in not closing these any quicker?
I guess the latent risk that we'd identified through the work that was really welcome at the time still exists. We're working around some of the issues at the moment. So just to remind the committee, one of the things we were concerned about was that we got really good at understanding the MCA's exposure to issues like the pandemic and loss of the office environment and so on, but we were less convinced that we'd had a really good fix on our exposure to suppliers who might not have the same mitigations to similar risk in their own organisation. So we were looking at making sure that we understood where we were exposed to individual suppliers and how we could effectively monitor those. So we've done as much work as we could at that point, but I think some of the challenges now is about getting it embedded into the business.
Thank you. All right, Liz, can we move on to your two reports for us?
Thank you, Chair. So we've completed two reports since the last meeting. The first report was the follow-up of the work that we did in terms of the asset management audit. Now, we've reported that of those original recommendations that 3 have now been fully implemented, but there are still a number of work streams that do still need completing. Just to summarise, I think a number of pieces of work has been undertaken at the close of the review, but in hindsight I think the team have gone back and actually, particularly around the management strategy and delivery plan, felt that it didn't quite cover the needs of the organisation. So that piece of work is still being undertaken and it's being refreshed. So that's the key outstanding piece of work in terms of what we would expect to see in place.
It's just on this one, we had a slight hitch in that we lost our head of assets and facilities just before Christmas. So work that we'd anticipated having done by now, we've had to put on hold whilst we go out to recruit. But I'm pleased to say we offered the position to an incumbent on Monday, and they've verbally accepted.
Any questions, David?
Thanks. I mean, just a quickie on these. There's recommendations on maximising commercial income and reviewing letting income. I had a question. I mean, what sort of sums are we talking about? 'Cause clearly, if they're significant sums and we're not, particularly in a high interest rate, a high inflation environment, we're not picking these up, we could be losing significant amounts of income.
It falls into two buckets really. So we have a significant commercial property that the committee will be familiar with, the Advanced Manufacturing Park Technology Centre, which is our flagship accommodation up at the Advanced Manufacturing Park in Catcliffe in Rotherham. So that generates a significant income stream for the MCA, which funds much of our core activity where we don't get grants. Now we have a managing agent who's responsible for tenancy management in that space, so that's the biggest risk, but we also have a really strong mitigation in that space. Where we also have income generation is through our interchanges and advertising income on things like bus shelters. So if any of you have taken a walk through our interchanges of late, you'll have probably seen lots of shuttered up units, and that's just reflecting changes to retail post-pandemic. There's not as much call for the WH Smith in the interchange where footfall's fallen quite drastically. And what we were really hoping for is to be able to come up with a revised commercial strategy about what we do about that sort of space. I'm not sure what the answer is. Every town centre is suffering at the moment, but we do need a longer term approach to this because the units are being under occupied, and that brings consequences beyond just a financial return. But it adds to things like we discussed earlier about antisocial behaviour. If we've not got as many people wandering through the interchange coming in buying stuff, it adds to a sense of neglect as well. So we wanted to get on top of that as well.
Thank you. Next report, Liz. Thank you.
Thank you. So we carried out a review of net zero. So the review looked about the progress that had been made from when the original climate emergency was declared, the plans that were put into place at the time, and then the progress of implementation of the actions that came out of that plan. We've given a partial assurance opinion. Now, what we have tried to highlight is the acknowledgement of there is lots of projects being undertaken, there's lots of pieces of work, but this review is about how the authority demonstrates the bringing together of all those different strands and work streams and actually pulling it into a strategy or a plan that actually gives assurance and provides progress being made in terms of that overall arching meeting net zero. So I wasn't going to page turn because I know you've got officers in the room, so I'm happy to take any questions.
We have got a presentation coming up on net
Yeah.
zero, which is the next item. So we can either wait for that, or we can comment on this as it stands now. John, did you want to?
If I kick off from the perspective of the MCA, so I think it is a very fair report for a point in time in our development, and I think that's the crucial thing. So we have got a number of things in train. We're building a team, building a strategy. There is a lot of activity, but you're right, it's not a strategy at the moment, or strategic delivery, it's tactical delivery. So that's a key challenge we've got in hand. It also sits alongside an MCA, which itself is developing, partly through reviews that Lyndsey touched on in terms of our governance framework. We are looking both internally within the organisation, but also in terms of how the region as a whole works. That will definitely need to address how we can ensure there is proper transparency and accountability in terms of our climate change net zero activities, which are obviously a really central part of what we have to do. And there are changes in the national framework. So in a way, the challenges we face are a subset of wider challenges that all public bodies face. One of the big issues is government funding, and there's a lack of a forward look of government funding at a proportionate scale for the ambition. So there's a lot to do. Now I could sort of sit here and use all of that as an excuse and try and kick the can down the road. But I think that's where the report is fair, that we mustn't kick this can down the road. We need to make sure that our governance review does address appropriate transparency and accountability, and we need to complete, as Richard and I are doing, our sort of building of a team to deliver ambitions, and we need to do that at pace. Thank you.
Okay. David, you had something, I think.
I mean, I think you're going to cover it later on, so I won't take too much time now. It's small to note that currently we're saying this is a really high impact risk when we look at the risk register, and it's really likely to happen. So it's a 25 on our risk register. Clearly, we all ought to be alarmed if we're actually saying that's the situation. We're actually saying it, you know, we all agree it's really important, but that actually we're really not mitigating that risk at all at the moment. I'm hoping in the presentation you're going to come on to, you're going to give us some reassurance that we have plans to mitigate that risk down. You know, we have time because this is quite long term. There's a lot of things we are actually doing, albeit they're not in yet, and we're perhaps slightly over again the residual risk there, because a residual risk of 25 should be a worry for everybody in the organisation. It's going to happen, and it's really high impact when it does. It's not a comfortable place to be. But I sort of await your presentation to see if we get a bit more comfort there.
Because address that now, because it is, and leading into what Richard will say, because it's a really important challenge, I think. I think the risk rating is fair, and there is a serious strategic issue facing the region about the mismatch between national ambition. So this isn't uniquely a South Yorkshire issue. Our regional and local ambitions. So we are part of this, absolutely. This is not just about looking at central government, but there is a mismatch between those aspirations, which are science-based, reflect the international consensus on what needs to be done to keep the climate within a acceptable level of risk, and the tools that are available nationally and locally to close that gap. There is, and I think it is very serious, we are developing activities, programme of action to, one, I think, crystallise that gap, to bring that out as a major political issue, but secondly, to progress where we do have tools, or we can develop tools, activities to start tackling that gap. But those tools, even viewed ambitiously, are short of what's actually required. And I think this is the beginning of a debate nationally and locally about that mismatch.
Unless there's any further questions for Liz, I suggest we go straight into your presentation, and then we can take this further.
The system works. The presentation's up. That's a good start. Just to build on the point that John just made in terms of risk. Net zero is a bit of a strange one, in that we could do everything that we could do. We could be net zero 2040, we could achieve all our targets and reduce our carbon, and we will still feel the impacts of climate change. So that kind of risk management and the residual risk that sits there is kind of independent of our action in that way. And it's quite then a challenge to put forward programmes, because you are not necessarily eating into that residual risk by our action on climate change, because it is collective action. It requires action at a global level. So when we're looking at risks associated with this subject matter in this portfolio, we need to think about the impacts that climate change will have and look at adaptation to those risks so that we can minimise their impact. But we also need to look at whether or not we are seen to be, and whether we are playing our part, and there's another inherent risk in that as well. So we could be accused of not meeting the commitments and forming part of that collective action, and that is a risk that sits on the MCA and its associated organisations. So the plan today really was to look at what our work programme is within the net zero portfolio in the MCA, and how it speaks to and addresses some of the points that have been raised by the internal audit. There's a lot of detail in here, and John has given me a virtual kick under the desk to say there's too much information in this. So I will skip through it. Committee members are welcome to this information if you want to delve into it more.
Are you happy for us to ask questions at any point?
Yeah, I think that's the
Or do
best
you want
way.
us
If there
to
is something that's raised within a slide that you say you want more information on, we'll cover that. Otherwise, I will gallop through it at a fair old rate. Just a little bit of the background as to why we have our net zero declaration. It does form part of the strategic economic plan, the stronger, fairer, greener overarching requirements for South Yorkshire. And we, as was highlighted before, we set this target of becoming a net zero economy by 2040. In terms of the impact that South Yorkshire has on climate, it is multifold, as everywhere is. There isn't a single element that we can address. And again, I think that's important when we're looking at designing programmes. There isn't one thing that we can do as South Yorkshire or as the MCA that will fix it. We do have to look at a multifaceted approach. We do have to look at action across multiple sectors, recognising that you can't read any of the key on that, but there's some coloured blobs and each one's got a label on it. Breaking that down a little bit, we have seen reduction in carbon emissions. So this graph is from 2005 to 2019 and shows how across most sectors there has been a reduction in carbon emissions. It also tries to just draw out where they're from in terms of sectors, and roughly speaking it sits in thirds. So a third of our emissions are from our built environment, a third are from transport, and a third are from domestic. It's not quite perfect, but it's a good way of envisaging it. And as you can imagine, it's not quite equal quarters between the four constituent local authorities, typically based on population and activity, generates more. When you start to dig into it through sectors, you see how that changes depending on the geography of the different areas as well. One thing to note on this graph is most of the improvement has been made by changes in the national infrastructure. So the grid has decarbonised, we've taken off coal plants, we've taken off gas-fired plants, we've replaced them with renewables, and that has done most of the heavy lifting. That will still impact on us. There is a plan for the grid to be fully decarbonised by 2035, but that doesn't address a high reliance on the burning of natural gas locally. Most people in the room will have a natural gas boiler in their houses. Most offices and businesses will have some form. We've got it here, we burn natural gas to warm the place. And most of our industries are based on making heat with natural gas. We will have to address that. I've kind of summarised my own slide there. Significant reliance on natural gas across all our sectors. Our transport is our most reluctant to decarbonise because it doesn't have exposure to the national grid. It is about burning diesel and petrol. And as we've seen over the years, as vehicles have become more efficient, people use them more. The limiting factor on a lot of our use of cars was the fact that they did 20 miles to the gallon, and when they do 60 miles to the gallon, you find that people drive 3 times as more, or own 3 times as many cars. So it's stubborn in its reluctance to decarbonise. And there are associated issues. I wrote this slide before the current issues with fuel poverty, and it was an issue then, it's even more now. We used to quote, I think, that 19% of residents in South Yorkshire lived in fuel poverty. It's probably more like half or more now. So it's a significant issue. And some of these issues can be solved by decarbonisation, by energy efficiency. We can help with some of those. So the overarching need is to use less. Reducing demand and increasing energy efficiency is the key to all these things. It's a hierarchy. That's what you do first. We do need to increase the use of renewables locally. South Yorkshire doesn't pull its weight in terms of energy generation. You wouldn't expect it to. We're not on the coasts with access to high wind. We're not on major rivers where we've got big power stations, so we are a net importer of power, but we could do more in terms of the generation of renewable energy locally. We need to electrify our processes, our domestic heat, our industrial processes and our transport. And we need to look at fuel switching for those who cannot do that. And there's some good work locally on that for some of our high intensity industries. And we need to look at natural solutions as well. So we need to improve the ability of our natural spaces to sequester carbon. So that's in soils, that's in peatland restoration, that's in growing more trees. So we achieve a net zero South Yorkshire by doing all these things. Again, it's worth noting that this is collective action across South Yorkshire. Often when I refer to we, that's what I mean. I don't mean the MCA. We are not going to fix this without people. We're going to fix this with them. So we're working on developing these pathways to zero across these different sectors. What will we need to do? And the idea is that we can identify that. We're the only body that really sits at the level in South Yorkshire who could own this data and do this analysis. And then we can identify sectors that are not active enough. So we can identify market failures, we can nudge, we can push, we can tailor our investments towards trying to address some of those, while at the same time and critically achieving those co-benefits. I think within the commercial and industrial sector, that's long been recognised that you have a commercial advantage. It's bottom line stuff. If you're more energy efficient and you spend less money on gas and power, you're more profitable. It's the right thing to do, so they will do that anyway. It's a more difficult sell for other areas. So what we'll end up with a pathway to zero. The net in net zero means that we have to increase that natural carbon sequestration that I talked about. We will always have residual emissions. All of human activity emits carbon. There's no way of getting away from that. So while we can minimise, we'll never get it to zero. The way we get to a net zero point is by increasing that natural sequestration through, through trees and soil and peatland. You definitely can't see this next slide. All the greatest information is on this one. So if you'd just like to take 10 minutes to read this. This is just trying to show you how we've done some of this analysis. This is the logic model for the net zero programme. It lays out in tremendous detail why we're doing this, how we will judge whether it's a success, what are the inputs we need to the programme, the activities we'll undertake, and critically the outputs of those activities leading to the impacts that we want to see. It's a way of trying to distill on a single page the why and the how of it. I say we won't go into much more detail on that. What I think is maybe more interesting is looking at some of these pathways. This is an example. This is transport. You can see how the carbon emissions are built up of our reliance on petrol, diesel and a little bit of electricity, and what we would need to do. This doesn't get down to programme level. This is just saying how we could get to a zero or very low carbon point through efficiency, through consolidation, through modal shift, through electrification and through grid decarbonisation. And what we can highlight on this is where we have programmes and schemes that are currently supporting that. So our active travel schemes are all about modal shift, ideally from private cars into active travel modes, into wheeling and walking. Our EV charge point programme, although only small, does contribute towards the support of electrification of our fleet, and schemes through CRSTS and the Zebra buses will look at electrification of our public transport fleet. Again, we are maybe only taking small chunks out of some of these, but they are in support of. What we need to do is work out where we, as the MCA, can do more, where we need partners to step up and start taking some of this weight, and where there are policy gaps where currently nothing is happening that we need to work out how we intervene. And as John quite rightly said before, some of this will be reliant on central government support. But for us in developing this programme, it's about being able to put that picture forward, to create that pipeline of opportunities. So when funding calls are made, we can respond with well thought through programmes that will deliver on our wider targets. This is an example for housing retrofit, which is a programme we're currently in development. Again, I'm not going to go into this, but it just kind of shows the complexity of trying to develop programmes for South Yorkshire wide interventions. It needs a lot of different elements to come together to make housing retrofit, which is the improvement of our domestic stock through fabric first insulation, but also through decarbonisation of heat sources. To make that come together, it's not just about throwing money at putting insulation in houses. It's also about understanding what that housing stock is, having finance offers that work for different tenures. So if you own your own home, if it's private rental, if it's social housing, need different financial mechanisms. We also need a skills base and a contractor base who can deliver it. What we found is, even with the limited funding that we get from central government on social housing, it's very easy to overwhelm a local market. Prices go up, or standards slip, or lead times extend, and that doesn't help us. So in developing some of these bigger programs, we have to have that, say, approach across multiple sectors to achieve. And again, I won't go through these, but we're in the stages of early development. I mean, some of these are just simple graphics to give you an illustration of how we would decarbonise housing, how we would decarbonise the built environment, how we could decarbonise transportation. And it's for us to then start to delve into each of those and identify what those programs could be within each element. So final slide for me is just to tell you what the 2023-24 work programme is. As John said, we're expanding our resources. It was highlighted within the audit report that we are a very small team, technically the smallest team of one. So we're going to expand that into some more people to help lead on some of these elements. Continue on our data and pathway development. We've got a very good project in conjunction with the two universities in Sheffield to improve the resolution and timeliness of our emissions data. At the moment, we collect data from bays 2 years in arrears. It's very difficult to make strategic or tactical decisions based on data that's that old. Also improving the data that we use to look at the impact of the schemes that we're currently running. And that's not just schemes that are badged up as net zero. That's all the schemes that the MCA and constituent authorities run. So we'll be continuing to develop programmes, as I said, in domestic. We're looking at domestic retrofit. Across transport, there are multiple schemes. The built environment, so industry and commercial sector, we're looking at our clean energy strategy and how that interacts with businesses and what we can do to support that. And within nature, we're doing a woodland creation project. It's one of the mayor's key topics. He wants to plant a significant amount of trees, so we're working out how to do that. And we will be mandated by government to produce a local nature recovery strategy, which will talk to some of that. And finally, to address some of the points again that were made within the audit report, it was highlighted that there isn't a huge amount of awareness within the MCA about these issues, and we need to spread that. So we piloted carbon literacy training for staff in November, and we will be rolling that out this year to include more people. That'll be an ongoing programme of, as new starters come in, we'll train them and we'll be picking up staff. And we had some good feedback on that training. One person did say to me it wasn't as boring as they expected, which I am taking as a success.
High praise.
High praise indeed. So that's it in terms of a summary. If anybody's got any specific questions on any elements of that, happy to try and address them.
Thank you for that. I wonder whether it's possible, as we couldn't necessarily see all this, whether you're able to circulate the presentation to us, and perhaps we can come back with further questions once we get into that detail. But I'd got one for you, which is the chestnut. Well, it's almost like the elephant in the room, really, which is to do with transport and vehicles and vehicle charging infrastructure, which the country is trying to get to for 2030, but is progressing very, very slowly. And I'm wondering how you are trying to interact with that, and for the local community, trying to speed that up, because it's a key requirement.
Yeah, so as I said, we have a programme that we're running at the moment across all the local authorities, installing chargers in public spaces. There is a new round of funding called the Levi funding, which we're looking at applying for, and how that contributes towards an EV strategy for the region. There are some difficult decisions to be made around infrastructure. Do you concentrate on where the emissions are generated? So that is some of the bigger cars doing longer journeys. Do you look at provision for people who currently can't afford an EV, but you'd like them to move into that world? So some on-street charging and putting infrastructure in place there. This does need to be developed as part of a wider strategy. It is worth saying that a lot of the issues around transport in South Yorkshire are caused by the volume of cars that we have. So just replacing like for like petrol and diesel cars with electric cars goes some way to decarbonising, but it doesn't get us out of the problems that we've got. So the impacts on the economy from congestion, the impacts on air quality are not solved completely by that switch. So it does need to be part of a coherent strategy, which ultimately is fewer cars driven less often. That's what solves a lot of the issues we've got on public transport. That's what helps with health and well-being for people, is to get people out of cars and into other modes.
Question in?
This is all going to be down to individual action, I guess. And if individuals aren't willing to take the action, then we're in trouble. Politicians are certainly in trouble.
Yeah.
And I get into this lead, do a lead, do I explain, do I follow, do I hope for the best type situation. Very often you get a chart after the budget saying what this means for, this family, that family, 2 kids. Is there a piece of work where somebody says what this means for you, like you or your neighbour has to stop using a vehicle on the road, or that's, that seems to me, you talked about cutting the car population. I've had seen figures of between 20 and 40% reduction in boxes on the roads with a wheel at either corner.
Yeah.
And if you're retrofitting property, then as I understand it, you can achieve great economy of scale, and it's often said, well, we need these green jobs. I think about the Decent Homes programme. There are still houses in Sheffield that haven't had their decent homes standards. I'm not slandering my authority there. It might be just a handful because they've never actually had the cooperation to get them done, or the money disappeared. So people are going to have to accept in some of our houses smaller rooms, so more insulation on the outside. It's a lot.
I think you're right to point that out.
And you've got to spell out and it's not just us, is it? It's every outfit in the country and every outfit in South Yorkshire, not just the things that we control. It's enormous.
There is a danger, and
is it so enormous? Is your danger so enormous? I should think mitigation is what we're into here.
We have to do both. We have to fulfil, I think, our responsibility as global citizens to reduce our carbon emissions, because the impact of what we do here has an impact on everybody. And there's a similar chart that I could show in terms of what South Yorkshire's carbon impact is. You can look at it globally and you can say, people often want to point to China and say it's China's problem. It isn't, it's everybody's problem. Everybody plays a part in that. So there's no way of sort of excusing and saying it's somebody else that's got to do it. You're right to point out that ultimately a lot of these things come down to individual action. Because individuals run companies, individuals run organisations, individuals make decisions they make at home. So it will be a combination of what we do as individuals. The danger bit that I was going to talk about is it can come across as we've all got to wear hair shirts and be miserable. But we're a way off that yet. A lot of the things we're talking about here in terms of things like retrofitting houses, there could be an impact if you can't external wall insulate, that your rooms become slightly smaller. But they become warmer and they become cheaper. And the sort of co-benefits of some of that. There are studies that show that kids do better at school if you've got a warm house. Your kids don't get asthma as much if you've got a less damp house, and we've seen some examples of much more serious consequences than that lately. If you reduce the amount of traffic on the roads and congestion reduces, it's a nicer place to live. And I think we do need, with a lot of these programs, to not think of them as punishing people and you've got to change your life. You have got to change your life, but we can change it for the better. So we can have healthier, happier neighbourhoods that are also lower carbon. As I said before, my background is working with businesses, if you reduce your energy consumption, you become a better, more competitive business. If you use less resources, you become a better, more competitive business. So there are lots of opportunities to live happier, healthier, better lives, be better, more competitive businesses, and at the same time meet this agenda. But we do often fall into the, oh, this is far too big, we're never going to fix it. And you know, I lose sleep over that kind of thing. But
it is something we're all going to have to grapple with as individuals. I'm going to have to move us on because time is pressing.
Thank you for your time.
So thank you for that. If you can send the presentation to everybody, and if we've got any
Thank you for the
questions.
reply. I found that an encouraging reply.
Right, we're on to risk. There's feedback from me.
Chair, I think we missed. Not on the risk report, are we? Transport working group.
Yeah, that's me. But it is about risk.
Oh,
Sorry. No, we're on the same page. We're on to risk, and we have a subcommittee which I chair with regard to transport risks. We duly met. We now have terms of reference which the subgroup approved. We work quorate. We concentrated really on looking at whether any risks had significantly changed, and I don't think they have, and we delved down particularly into the top risks, and I'll comment really on the top 5, I think. We didn't concentrate on the tram because obviously you're going to do the presentation, so we just looked at what we call the operational risks. The key ones are bus patronage, continued funding and support from the government with regard to the level of bus continuity. We know that this funding is due to finish at the end of March. The MCA has offered to support to the end of July. We're waiting to see what the outcome is now in terms of further government support. There's quite a few risks with regard to the tram infrastructure, which is particularly old and aged, and maintenance risks are getting heavier. There is a robust review programme which looks at elements of the infrastructure to make sure that there's continuity and it's not failing, so we went through that. We have this old age chestnut of Barnard Road, which is a potential collision impact between cars and trams, and it's not getting any better. So we did suggest if the committee wanted to help on that, it could, in terms of prodding in any particular area. And we looked at one other item which is new on the risk register, which is the closure of the airport. Now the impact of that has still got to be fed across, and I guess that will be done in due course. Ian, is there anything you think that I've missed in that?
No, I think we had a comprehensive overview. In a sense, I said it was quite daunting, the amount of risks that we had. But as you said, Reece, it's encouraging, and it is encouraging to know that we've got a handle on lots of levels of risk that we face, and we're quantifying it and reacting to it. So I think we had an interesting and useful session.
We did, and I think the thing that encouraged us most was we had a very strong risk process behind it and the risk register. And it's now moved up, I mentioned this earlier, a couple of notches, so I'm very impressed with the way that that's come together. Anyway, let's go to the press.
Thank you, Chair. I would like to introduce you all to Chris Coleman, who is the Programme Director for Light Rail, and he will talk us through the slides, so I'll pull them up, but Chris will talk you through it.
Thank you. So we've got, I'll wait for the slides to come up. So I'm Chris Coleman, I'm the Light Rail Programme Director. I report into Pat, and my role is to lead on the concession as well as the mass transit. So I'm overseeing, and you mentioned just a moment ago about the assets and the condition of the assets and the investment that we need to put into maintaining the continuity of the tram system. So it's overseeing both that process through the OBC with the DFT and ourselves, as well as the concession end. So the concession end is in March 2024. That's a key date for us because it can't move, that's when the concession expires with Sizewell. So we have a number of slides that will take you through where we are in terms of managing the programme, the key activity, the key risks. If I go through the slides, and if you have any questions at the end, I'm happy to take any questions and answer them then. So we'll take you through the background and overview, which is basically stating the current position that we're at now and giving you some update. We'll have a look at the concession mobilisation plan, and that'll just look at the key work streams. So what is it we're doing? What activities are we doing to make sure that we're covering all of the issues that need to be managed in a timely manner through to March 24? And then the key slide is going to be the key risks and how we're controlling those. So in terms of the background, we, SIPT own the assets, and the assets include the tram, the infrastructure, the tunnels, the bridges, all of the assets that operate the tram system. It was built in 1994 and was operated as a wholly owned subsidiary known as South Yorkshire Supertram Limited, Sizewell. In 2000, that was sold to Stagecoach, who are still known as Sizewell. They take all operational risks as well as financial risks for operating the system and have done since 2000. So revenue risk, service performance, customer satisfaction, all rests with Sizewell. The contract expires at the end of March 2024. When that expires, the responsibility for operating and maintaining the system, including financial risk, will revert to the MCA, which is an important date. At that point, all of the costs, the cost risk, the revenue risk, will sit with the combined authority. So at a board meeting in October 2022, a decision approval was given for the combined authority to set up a wholly owned subsidiary for Sizewell to transfer into operating the tram system. So the objective that we have is to transfer Stagecoach entity, that's the people, across into the new co. If we call it new co, that's a new wholly owned subsidiary from March 2024. So mobilising and transferring businesses like this is not unusual. It is a tried and tested methodology in terms of mobilising and demobilising. What we're putting in place is all of the structures and balances and checks to make sure that we're diligently doing that with rigour. So my next slide takes you through our approach to that. So we've got a programme set up, as you would expect. We're currently recruiting resources, a number of specialist skills. We're developing a communications and stakeholder plan, and we're looking at all of the key milestones. So what do we need to do by when? What are the key deliverable dates? Part of that also is data and intelligence. What due diligence can we do? So we already understand quite a bit about Supertram because we manage it as a client. We get reports on performance, we get to interrogate specific incidents, and we have a fairly good understanding. But actually what we really need is a thorough understanding about every aspect of the business because it's coming into the wholly owned subsidiary. So we've set up a data room. We're talking to Stagecoach, who I have to say have been very supportive and receptive, and they're equally ambitious to ensure that they hand over the concession in a very professional way that respects our desire to do that to the best standard, and we mutually agree that we do this to the best of our endeavours, which is really, really helpful. So we're working with Stagecoach to start to gather lots more data to have that full due diligence and understanding about what the entity is that we're taking on. We also have a transition agreement, and we have a contract, and there are lots of issues that you normally will need to work through, commercial issues around stock, around assets, asset transfer, asset handback. So we're working through a comprehensive list of matters, and it's going very well in terms of clarity and understanding and closeout. There's a lot to do between now and March 24, but we are working very closely with regular dialogue and meetings through a transition agreement. Beneath that, we've got some core mobilisation work streams. So these are specific areas with specific skills, such as legal. So we've got legal advice to guide us through setting up the wholly owned subsidiary, model contract, service level specification, and just to make sure that what we're putting in place will be effective and add value to the MCA in terms of the outputs from Sizewell in March 2024. We've already undertaken a piece of work around architecture assessment. So we've already assessed, and I'll explain a little bit more now. Stagecoach have a shared service centre in Stockport. So there's a number of corporate activities in Stockport that are provided to Sizewell. We need to unpick some of those corporate services and set them up. So we've done an architecture review to understand what licenses, what systems, what hardware and software needs to be mapped over. We have a clear view and we have a very clear understanding of that. And we're now developing a series of activities to deliver that change with Stagecoach again. People, really important, not that anything is less important, but what's really important for continuity is that when the people come across in March 2024, that they feel valued, they feel respected, and they want to be part of the new entity. And that's for continuity. So we've already engaged with Sizewell and Stagecoach. We've started some staff workshops, engagement, Q&As. So we're already building relationships, and the people leg is the enabler to bring the hearts and minds and make sure that we do this together and they feel valued and supported, and that we get a seamless transfer. What we need on day one is staff that are motivated, they're clear, they're supported, they understand the direction of travel, they understand our ambition, and they continue to do a great job. So the people leg is a really important enabler for us to do this successfully, such that the customer doesn't see that impact. They get the continued service they get today. Retailing systems, we do need to set up a new retailing system. So how do we retail our products or services? It currently runs through Stagecoach's website and app. We need to set up our own website and app and retail. That's really important to us, because if revenue risk will sit with the MCA through the wholly owned subsidiary, we need to make sure that we set those systems and processes up that work for the customer, that's attractive, it's easy, it's frictionless, and we can grow our revenue and gives customers and confidence in that experience of travelling by tram. So setting up the retail systems is really, really very important that we're going to do. And how do we market that? What's the day one plan? So we're considering, what is the day one plan? What does that look like? The most important thing that we're preparing for is that the trams run, they're safe to operate for the staff and the customer. Customers can buy tickets, staff get paid, so we need to make sure that we have new payroll systems. So there's a lot we need to make sure for day one. Then how do we market that? So we're looking at developing a plan about our marketing strategy that's linked to the retails and products, and as well as what's the service we want to provide for the customer. As you'd expect, we have procurement and contracts. So there are a number of contracts that Stagecoach have got in place, some of which we may continue with, some of which we may not. So we may novate, we may end, we may start new contracts. We've got a suite of a list of contracts that they have in place. We just need to work through that now to make sure that we can have the checks and balances in place for seamless continuity. Sorry, bear with me a second. And the last two areas that we have there in terms of specific focuses is operations. So what timetable do we want? What's the right timetable? What's demand like? What service meets with that demand and makes it attractive for people to use the tram? What's the customer offer? What's revenue protection? So how does this all pull together? What resources do we have? How can we make it more financially sustainable? So all of these things we need to work through that feed into the service level specification. And then lastly, you'll see, if you can see on the slide, is engineering. So we have to make sure that the network is reliable. The trams run on time. The vehicles are reliable. The infrastructure is reliable. And a key piece of work through that is the renewals strategy. So I mentioned briefly around the CRSTS. We've got £100 million to address some of the life expired assets on the system. So the team are they're currently understanding what the condition of the asset is, and then developing a plan about how do we address that. What's really important to us is the way in which we do that. And I'll just stay on this point if I may, because what we don't want to do is disrupt the customer. What we ideally want to do is maintain this network without shutting it, closing it, affecting or disrupting. We want people to feel they can travel regularly and confidently and not be disrupted. So our strategy for how we want to do rail replacement, for example, how we want to upgrade certain assets. So we're looking at depot, we're looking at power, we're looking at trams and refurbishment. We've got to be very smart around how we apply that so we disrupt minimally the customer and the wholly owned subsidiary. So we're developing an asset management strategy that blends both the renewals and the normal day-to-day BAU maintenance activities. So there's some of the work streams. That's the approach we're taking in terms of programme governance and programme oversight. I think what I'd like to do now in the last slide is just highlight some of the risks, but then what are the control measures for them risks? I mentioned just then, not achieving a seamless transfer on day one, operations stop, that is a risk. So as I've just talked you through, we are very clear about what we need to do, when we need to do it, and how we need to do it. So that mobilisation plan is integral to having a seamless, safe transfer. It's mobilising for us, but it's demobilising for Stagecoach. And I'm happy to say that we're working very closely on that. We've talked about contract supply. It's a risk. It's not one that we're concerned about. We just need to work through all of those contractual changes to make sure that it's seamless, as I've described. And we've agreed in terms of employee engagement, we've set a series of dates up each quarter where we're going to continue to talk with and meet with and engage the staff. And I think it's really important they get to understand who we are as the MCA. We build that relationship and we answer any queries and questions that we've got. That's an important pillar for us. So I think we understand the challenges for day one. We know what we need to do. There is a lot to do. We have a plan for dealing with that and addressing that. The second risk is insufficient mobilisation staff in terms of resources. So I've highlighted a number of areas that we need to recruit. It's a challenging market in terms of getting the right people in to do these types of roles, because lots of authorities are seeking similar skill sets, like the West Midlands, for example. So we are taking a very targeted approach with our HR team to make sure that we go through the right agencies and corporations that can provide us with the skills and competencies to do this. And we need to hit the ground with our feet running. So we are very focused on this, and we're currently going through recruitment just now to fill a number of these positions that are important to us. The next risk is an adverse impact on customer demand as a result of the renewal plan impacting on operational service levels. This is around our asset maintenance strategy. This is around understanding clearly when do we need to do work. But if we do need to do it instead of a large closure, would it be easier, or could we do it on 5 weekends at night out of hours so it's less disruptive? So we need to set a strategy for how we're going to do that. And we just have to be creative and smart around it. Instead of taking let's close and renew, let's try and do it a different way that has less impact. So that work is in process. It isn't complete by any means yet, but that is a risk that we know we need to manage through that process. The impact of COVID on customer demand and the economy affecting financial performance. The financial sustainability is very important to us. So the service that we operate, the efficiency of that service, can we ensure that the costs associated with that are fully controlled? That's part of our review. The most important thing we can do actually is run on time, or deliver the customer promise, provide a great service, and grow the passenger numbers. So it really is around the day one is delivering what we say we're going to do, provide a reliable service that's attractive, and get people to use the tram system. That could be through the products that we offer, through the retailing experience, through the customer experience. So all of those work streams around what the customer offer is, what the retail offer is, and how we go from day one is going to be the way that we address that particular risk. And the other thing I'd like to say is we're going to develop a 5-year business plan. So year one, what are the critical success milestones? How do we deliver those? Year two, what are the critical success factors? With a view to growing the attractiveness of this system and making it financially sustainable. So there's a lot to do. There is a lot to do. There isn't a huge amount of time till March next year, but we do know what things we need to do and how to do it, and we're currently recruiting a lot of the resources to enable us to deliver that. So I hope that's given you a very quick overview of, where are we, what are the risks, what are we doing about it. A lot of work needs to still be done, it's fair to say, but we're on with that. So
there's a lot
been
in
helpful.
there. I think that's been very good. A couple of comments for me. I'm familiar with your activity because that's in my background. And it's going to be very difficult for you, I think, to manage a TUPE process, take on the tram system. I don't know whether you're going to get the IP, which enables you to take the maintenance regime with you, or whether you've got to buy that, or whether you can get that contractually. You didn't mention obsolescence in there, which is the fact that you're going to have to run an aged fleet until such time as you either renew or you buy new, and I think it's renewals we're talking about, and maybe a major refurbishment program that's then got to be spec'd, and you've got to find an organisation to do that for you, which is going to take time. So, I mean, having the availability and the reliability in managing the obsolescence and everything else once you've got it in-house so that you can run a service is going to be critical. The one thing I would ask is, when you TUPE across, you don't necessarily get the management skills to run the activity with you. So are you going to have the management skills in-house? I know you've got your recruitment program, and the fact that you're here is good news because that's part of it. Are you going to have the management skills to be able to handle this?
So there were two parts to that. Sorry, I think there were two parts to that. I think the management skills for continuity of operating the system is on the assumption around TUPE. There is a risk there that certain individuals do not wish to transfer. So we have already identified with Stagecoach the critical skills and people and retirement profiles and things to understand, is there a risk in terms of employee continuity and skills and competencies. So we already have that under the microscope in terms of checking and reviewing and monitoring that particular risk. In terms of the skills and competencies to manage the transfer, yes, we're on with that. We've identified what skills we need. We're currently recruiting for a lot of those skills, and if we get them, I think we'll be in a place that we can deliver the change seamlessly in the time that we have, but we have to get a pace on. In terms of the asset management, in terms of obsolescence, that is part of the CRSTS activities. So we are looking at the vehicle, its reliability, refurbishment. So all of those things are in train of thought around options that we can apply post March 24.
Thank you. Anybody else got any questions? Ian?
Yeah, so going back to the original contract arrangements, I'm glad to hear there's great cooperation. Did the contract, as set out originally, did it have various things in about what would happen at the end of the contract, how things would be handed over? Did it have anything to say about the management of the handover, or is it fresh work for us?
I think Steve's going to come on that, if that's okay.
Oh, it's you.
Thank you, Chair. It's fair to say the existing concession agreement has a limited amount of provision for end of concession. They have obligations in terms of maintenance and standards to hand over this system back to us, which are not, again, that comprehensive. So it wasn't something that was mapped out at the time the concession was laid, which is why Chris is working closely with Seisel now on the transition agreement to put that detail in place. So it's not what you would expect in a modern day concession or PFI type arrangement.
And I'm thinking that's a significant risk in itself, but can we have more reassurance?
That's why I'm saying,
yeah.
The fact that Chris is here and put the team in place, and he's working on the transition agreement with Seisel, is mitigating some of that risk.
Indeed, and that's exactly the point. We've mapped out through the transition agreement both Stagecoach's priorities in terms of demobilising, our priorities in terms of mobilising, and where we've got gaps between what the contract provides and what the contract doesn't provide. So there is absolute clarity between both parties around those emerging risks of transfer that may not be covered commercially, contractually. Those are some of the items that we're working through just now. But we're clear on what they are, we just need to work through them.
And when you're clear with what they are, have you started to put numbers on them yet, or are you just you're scoping out what the issues are at this stage? You're not at the stage of...
No, we are indeed assessing the numbers associated with that. Absolutely.
Thanks.
Right, I'm going to stop you there. Thank you very much. Again, could you send the presentation?
I appreciate we're running short of time, Chair. Just on these sort of final points, there's clearly a lot of risk here. At some stage, you're going to work up some plan Bs and contingencies if you can't get the staff in, if the maintenance isn't working, etc. And the other one is just a note. One of the things I didn't notice on there was the word pensions. If you're two-ping staff in, you'll be two-ping in either a liability or an asset. That can be many millions. If it's managed right, you can get the asset and keep it up front and subsume the liability into the next 25 years with the pension fund. If it's managed wrongly, the liability hits you as a big upfront bill, and the asset the operator walks off with. So it's worth liaising with finance to make sure that that's managed early, because I have seen it managed well and not so well over the years.
Thank you. If I may, so two points. On the risk, we have a risk register. So whilst we have the corporate risk register, we have project risk registers too. So we have very detailed risk identification and assessment, and we're continually working through that. So in terms of contingencies, we're already looking at issues, logs and risks, as you'd normally expect through a project like this. So we've got that covered. We need to manage those risks, of course, in due course. And with regard to pensions, we're talking to the HR team in terms of, I think what's really important with the pensions is that the staff will not be transferring to the MCA pensions. The law in terms of TUPE applies in terms of, and don't quote me on the exact wording, but providing a similar arrangement. It's not obligating us to bring them into the MCA. So we are working with HR on specific pensions, and we will be bringing in specific pensions advisors as part of that kind of HR TUPE transfer. As you'd expect, that's an important question from the staff.
Thank you. Thank you very much. I think we'll close on you at that point. Now we have hit 1 o'clock. I don't know whether anybody has to go.
I've got about 10 minutes.
I think we'll try and squeeze. I think if we try and squeeze through in the next 15 minutes, I think that'll help. We've got the risk register, which I've now said, and the risk process is very strong. If everybody's had a chance to look at that, have they got any questions rather than going into any depth? Because we've talked quite a lot on risk in certain areas. No, fine. Okay, thanks. Then we'll go on to the governance improvement plan then, please.
Thank you. Actually, I'll just introduce this report. You know, Claire's not here today. So this report to this committee on the progress with delivering the 22-23 governance improvement plan, which actions came out of the 21-22 annual governance review. The appendix to the paper sets out the progress to date against the Sit for Solids principles. For 22-23, we're looking at a more specific improvement plan arising from the review referenced in the next paper. So with more specific, smarter actions. So really just any questions from the committee about the paper, about the actions. But it is just brought to bring assurance to the committee that we are implementing the governance improvement plan.
One from me.
I think it's more training for members.
Yeah, I think that's on the agenda. We talked about it earlier as well. Yeah.
Okay. Right, we'll move to the next item then, which is the governance review process, which is with you again.
Again, this paper just really provides some detail on the process to be undertaken to review the effectiveness of the MCA systems of internal control, and the review will inform the annual governance statement for the accounts and the shape of the 22-23 governance improvement plan, which, as I said in the previous paper, hopefully will be more specific and targeted. And the initial findings of this review will be brought back to this committee in March. So really it was just, again, assure the committee that this is happening and that review will be brought back and its findings to this committee. So again, any questions?
No, thank you. And then the work plan. Has the work plan changed since last meeting? Any significance?
Very significant
I haven't got
change.
anything on it. No, we'll take that as stands then. So that just moves us on to the last item, which is the